So if you have a whole life insurance policy and you had a plan to fund a certain dollar amount for a long period of time, but now you want to reduce the amount that you're paying into that policy, is that possible? The answer is yes. However, it does depend if the policy was set up correctly from the beginning. What we're going to look at today is someone who has had a policy for about 5 years. We'll see that they started out by paying in exactly as what they originally planned, but then they reduced their payments. So we'll show exactly how they reduced their payments and then also how that has impacted the policy performance. Let's get on into it and have some fun talking about cash value life insurance. So what we have in this case study is a 44-year-old female. She started her policy back in 2020. The plan was to fund $50,000 per year for 5 years, which would put a total of $250,000 into the policy. The company she selected was MassMutual, one of the 4 major mutual companies, and the plan was really to fund it for 5 years. However, she might want to keep adding money. Now, that was the statement of might want to keep adding money was back from when she first started the policy in 2020. Things have changed since then. So the original illustration, this is what we want to start with. So when she started her policy in 2020, the dividend interest rate was 6.20%, meaning when she looks at the projection or the illustration, that dividend rate of 6.2% is what displays the growth. So let's take a look at this and we'll hit on that point first, and then I'll talk about the design, which we started with. So here's the original plan. She wanted to fund $50K per year for 5 years, which is a total of $250,000. Here is her money column. Now, this money column is based on the 2020 dividend interest rate of 6.20%. That is not what the policy will grow by, but that is the current gross crediting rate that is assumed with this illustration. And where we can see that is if we scroll to the bottom of this illustration, here we go, you'll see that the date was 2020. June 8th, 2020. I think I was 31 years old back then. Where's the time go? I don't know. But anyway, back to this guy. So you've got the cash value projected to hit 252 and change by year 5. At that point in time, she would have paid 250K. So her plan is really to get 250 grand into the policy, then just let it cook in terms of the growth over time, and then potentially use it for real estate deals. That's why she was interested in whole life insurance. The flexibility though. So the question is, if this is my plan, and this is what I sign off on with my formal contract, if life happens and I can't pay 50K or I just don't want to, can I reduce it? Yes, you can. Has to do with the policy design. So if this is you have $50,000 per year going into the policy. However, this shows a breakdown of where your money is going. Your money can go toward 2 main areas in a life insurance policy: the insurance premium, or what is called your paid up additions rider. We'll call that our PUA rider. I like to call it a cash dump-in because money I put here shows up in cash value. So the premium in red is at $5,000. That's 10% of the total payment, which is about as low as we could drive it with a MassMutual whole life insurance policy. So we want to know the limits that a specific insurance company offers and then push the premium as low as possible. That does 2 things. One, if life happens and I don't want to pay 50 anymore, what do you think she's committed to? The 5K. Everything above that is gravy. That gravy is just the cash value, if you like gravy. If not, think of it as like mashed potatoes with a good dinner. So that's the gravy, but she's committed to the 5K. So the first was that she's only committed to the 5,000, and the second is when I add that extra gravy, everything into the PUA rider, that's what maximizes my cash value, because the premium does not show up in cash value in the first year. With this product, it was actually the first and second year. So we want to minimize that premium as much as we can. Okay, so this is what was originally illustrated. What actually happened? So there's a couple things we want to look at here. First, time has passed and the dividend rate has changed. When she started her policy, the dividend rate was 6.20%. Came down a little bit and stayed down for 3 years, where it was at 6% flat. Not a big adjustment, but it is different. And then 2024 came up to 6.1%, and then this year, for 2025, it's 6.40%. So this will have a slight impact on the performance, but we'll measure the actual results. The other thing that's changed is her actual payments. She stayed pretty consistent for 4 years and then reduced her funding. So what we're going to look at here is the original illustration, what we just looked at, but then we'll compare that with the actual results. And in an effort to make things more transparent, we're going to look at the annual yield, which is the net rate of return. We'll see the policy growing by every year, and then the total gain, which is just the total amount of money you've earned from the life insurance company with respect to cash value. Make sense? All right, let's take a look at the performance. When we look at the original illustration, how we track the actual performance, what we want to look at specifically is what is called an annual statement, which is this guy. So the first year, cash value at the end of that year was $43,000 and change. That's about the same number we saw in the illustration. We're going to put them up side by side in a moment. The next year, there's the end of the first year, 2021. Then the next year, 2022, it's 88 and change. The next year, you're at 139 and change. And then the following year, you're at 193 and change. And then we can actually see what this year is projected to hit as well. She paid $50,000 per year for 4 years. It's in year 5 is where she reduced her funding. So let's take a look, and we're going to look at this on Excel just to make it simple. So here we go, $50K per year for 5 years. This matches the original illustration we just looked at. What we want to see though is what? Well, first, the annual yield. So we have the dividend rate. From that original illustration, it was 6.20%. The dividend rate is never what you're earning. We can just throw in a rate of return formula in there to make it a bit easier. I think this is so important to look at the first year because I'm at a loss. A lot of times I talk to folks, they have a whole life insurance policy and they think that they earned a positive return in the first year after speaking with their agent. It's like, no, you didn't. If you put in 50K and you have 43, did you make any money? No, you lost money. And that's over the full course of the year, and that's based on the annual statement that the insurance company says, here's exactly what your value is. And then we just calculate the difference from there. So it's so important just to be aware that we are losing money up front. That's like the biggest drawback to whole life insurance. But then each year thereafter, it gets stronger and stronger. But this does display your net return over time. Okay. And then the total gain is simply the difference between what she paid, so total funding, here by year 15, $250,000. Total cash value, $380,000. The difference, $130,000. That's her gain. That's how much she has received from the insurance company. And she paid into it for 5 years with the original illustration. So when we look at the actual performance, here's what we're going to look at. Years 1 through 4, she followed the original plan. She funded $50K per year for 4 years. What's the difference in cash value by the 4th year? Are they the same? No, but you might get your eyes crossed. Here's why. The original illustration showed 194, 934, and the actual results, 194, 394. Same numbers, but in a different order. Complete coincidence. Or is it? I think not. No, it is. So by the 4th year, it is almost right on par with what was originally projected, which is pretty cool, especially considering the dividend came down a little bit. Now, year 5, she didn't pay $50,000. Thought about it, discussed it, but thought it was best just to pay $5,000. So when you reduce your funding in a situation like this, how does it impact the policy performance? Well, the dividend rate came up a little bit. Look at your annual yield though, 4.67% compared to over here in the 5th year, it's 2.98%. Wow. Why so much higher? It's not because of the dividend. When you reduce your funding, when you pay less into PUAs, quite drastically in a case like this, usually in that specific year, when you reduce the funding, you see a bit of a higher return. And the reason why is because there are fees and expenses that are associated with your PUA deposits or anytime you make a premium payment. Those fees are going to drag down the net return. Now, does that mean I should just not pay those ever? No. Here's how I like to explain it. When you make a large PUA deposit, it might not perform so well that year, but then the next year, it's going to look better. So adding PUAs is ultimately what accelerates the cash value the most. But in this particular example, when I reduced it, that's why it's higher that year. Because a lot of times people ask that. 5K again the next year. What does that look like if she only pays in 5K? Return is about the same. Dividend came up now to 6.40%. When we compare that over here to 2025, there you go. Dividend rate, 4.41%. I'm sorry, net yield, 4.41%, where the dividend on the original illustration was 6.2. Compared to 2025, dividend 6.4, actual 4.68. A little bit stronger, which is nice. Now, she might increase the funding this year. She doesn't know yet, but she has that option to scale it back up to 50. She could even go up to 95 and make up for lost time if she wanted. But it could be anywhere from 5, really 0, up to 95 this upcoming year. The plan though, and what she requested the last time we put illustrations together was, what does it look like if I fund 5K per year, just that minimum amount, through policy year 10, and then stop? Show me what that looks like. Looks pretty good. So here we go. There's the dividend. This will change, but the returns look great. By year 15, total gain about 133, which is very comparable to the original illustration, even though she put less in, because it's the difference between the total payments and total cash value. Here's one thing I'll mention. The original illustration, we reduced that death benefit year 7 to 8. With the actual plan, we didn't do that. We can, and if we do that, you're going to see the net returns jump up a little bit, which is nice. The earliest you can drop a death benefit on a life insurance policy is usually year 8 without triggering what's called a modified endowment contract, a taxable event. All right, so that's an overview of the actual performance. Here's what it looks like with a little bit longer horizon. This chart goes all the way down to 70. It looks good over time. By 2045, 581 in cash value. And again, she's paid in a total, in this example now, of 230. So, can you reduce the funding even though your original plan did not factor that in? The answer is yes. It's very simple to do. People we work with do it all the time. And you can even set it up where it's very, very flexible. So I'll close with this. What some people do is set up policies just like she had, but they might go with a different company, like Guardian, for example. And the reason why is if 50K is my cap, meaning the max I could pay in, I'll set it up where I'm only billed for $5,000 per year. And then at my discretion, I can literally just throw more money into my PUA rider. It's very flexible. And I don't have to do that. So I've got the ability to add another 45K. And if I do it, I see it immediately show up in cash value. But at the same time, I'm not billed for that. So now I've got a lot of flexibility, which makes the product not feel like a burden. So I do hope this helps. If you have any questions, comments, thoughts, please let us know in the comments below. And as always, again, I hope this helps. Thanks so much.